Hello, here we are again, okay? This is our last day on Chapter 8. We're going to go through those quick studies I assigned for Chapter 8, and then we're going to start into Chapter 9, okay? Starting to get towards the end of it. Now, our next test is over Chapters 8 and Chapters 9, but we still have a little time to go here, so. Let's go ahead and dive right into the homework, okay? Quick study 8.5, I believe, was the first one I assigned. Is that correct? Okay. And that was establishing a petty cash fund. Let me go ahead and read that real quick. Quick study 8.5. Petty cash fund of the Cayley Agency is established at $75. We're on page 342 at the bottom. At the end of the current period, the fund contained $8.18. Okay. And had the following receipts. Film rentals, $26.50. Refreshments for meetings, $32.17. Both expenditures are going to be classified as entertainment expense. Postage was $5.15. Printing, $3. Prepared journal entries to record the establishment of the fund, and then B, the reimbursement of the fund. Okay? All right, let's take a look at those two entries. We'll talk about them a little bit. Okay? When we establish the fund, the debit is to petty cash, the credit is to cash. Okay? Like I said in previous lectures, the reimbursement journal entry I always do in 3 steps. The first step I say is how much money is in that box, how much more cash do I have to put in to bring it up to 75. And in this case, the number is $66.82, correct? Then the second step is I list the expenses and I book those. I go through the receipts. And then the third step I ask myself is, does this thing balance? And it does balance, doesn't it? Okay? It does balance. So we don't need to debit or credit a cash over and short account, correct? I think, and then the next thing they ask is identify the 2 events that cause a petty cash account to be credited. Well, notice that when we reimburse the fund, we credit cash. We do not credit petty cash. We credit cash, right? That's always a common mistake on tests. Okay? And really, the 2 answers to this other little question are kind of the same thing. Either when you reduce the fund or when the fund is being eliminated. And if you're eliminating the fund, you're really reducing it to 0, right? So in a way, there's really only one answer, is if you reduce the petty cash fund by any amount, including 0, which would be elimination. Okay? Now, there's always a petty cash question on the test, so that's usually good because people usually do pretty well on it, as long as they don't make one of those little mistakes that we've talked about. Okay? Okay, any questions on 8.5? All right, let's go to 8.7. Had a little mistake there in the book. Okay? There was a misprint in the book, and my smart students here pointed that out. Now, let me go ahead and show you what it is. It's that very last sentence where it says the bank statement included a $30 credit for interest earned. That should be a $5 credit for interest earned. Okay? Otherwise, your bank reconciliation didn't balance, did it? Okay? Now, if you're watching this online or the tape, you might want to just pause right now and redo the problem with the correct information. Okay? The book's usually pretty good about not having a whole lot of typos. I know the proofreaders they get are really good on this book usually. And but we did catch an error here, didn't we? Okay? So, for you folks at home, you might want to pause it, redo it. Let's go ahead and show the answer to that. Okay, there is the answer. Take a look at that real quick, and then we'll talk about it. And there, of course, is the correct interest earned amount of $5. All right. Okay, any questions on that? It's a lot easier when they give you the right numbers, isn't it? Okay.
Less time consuming.
Now let me ask you this. How many people bang their head against the wall going, this thing won't freaking balance? Okay? Yeah, most of you. I got to tell you, I wouldn't put an error in a book ever intentionally, but if you want to be the sort of person that looks on the bright side of life, it's not always a bad thing, okay? Because sometimes the learning that takes place with some situation like this is actually better than normal. Because it's like what you did then is you really tested everything you knew. You probably had a conversation like, okay, I know outstanding checks are deducted from the bank side. I know deposit in transit is added to the bank side. I know the bank service, and you really, you know, it's like if somebody challenges you in a debate. You have to really be able to argue your point, okay? And then some of you came to the point where you said, there is a mistake. That's good. That's good that you came to that. You didn't say, I don't understand this. You said, no, there is a mistake in this, okay? So I hope there won't be any more errors in the book. But when there are, I guess that's always that's the rationale I use. So any questions on exercise 8.7? I think I assigned 8.8 as well, did I not? Okay, let's take a look at that one real quick. Let's take a look at 8.8. All right, the following annual account balances are taken from Mizuno Sports, and they give us our accounts receivable and our net sales, okay? And for 2009 and 2008. What is the change in the number of days sales uncollected between 08 and 09? According to this analysis, is the company's collection of receivables improving? Okay. All right, let's take a look at that. First of all, the definition of days sales uncollected is right there at the bottom of the screen. It equals accounts receivable divided by net sales times 365. Okay? Now, if you calculate this for 2009 and 2008, you get these numbers. Okay? Did you get those numbers? Now, make sure you don't round, don't round that to 25 days and to 26 days. As a matter of fact, I actually prefer to take it out to 2 decimal places. Okay? I like to take these ratios out to 2 decimal places, okay? So, now, you always have to ask yourself with a ratio, do you want it to be high or do you want it to be low? It's not always the same, okay? Golf scores we want to be low, bowling scores we want to be high, right? So you got to ask yourself, are we going for high or are we going for low? Which is better?
Low.
Lower is better, right? We want our cash to come in quickly. So there's some slight improvement here, isn't there? There's some slight improvement in that it's improved from 08's number of 26.2 days to 09's number of 25.2. It took one less day to collect on the accounts receivable in 09 than in 08, okay? We don't know why this improvement occurred, but what are some possible reasons that this ratio could have improved?
Crack down on their accounts receivables.
Okay, what does that mean? What would that look like in real life? I agree with you.
Showed a little muscle.
Okay, what you're saying is maybe we have somebody who is a little bit more fervent in calling the accounts and getting to pay, right? Whereas the last person was just too nice, correct? Okay. What's another reason? Yeah, you said it. You said it, Zach.
Maybe change the discount and more people paid sooner because of that.
Right. Maybe we didn't have any discount, and so now we're on a 210 net 30. You see what I'm saying? And so now we have provided an incentive or something like that. Okay? Good. Yeah, those are both good ways that this ratio might have improved.
So is that why a lot of sellers will do that? So they can collect quicker?
Say that again, Brian.
Is that why a lot of sellers will do the 210 net 30 so that this ratio is a lot quicker?
Well, yes and no. It's not so much that they want the ratio that they get some sort of wonderful feeling if the ratio is low. It's just that they know that when the ratio is low, that means cash is coming in quicker, and that their cash flow is healthier. It's a subtle distinction, okay? And it would be like this. It would be like Zach plays baseball, right? It's like the coach just doesn't get some sort of sick satisfaction out of, he wants your ERA. Do you pitch? He wants your ERA to be low because he loves low ERAs. Really, when in the end, what's the only thing your coach cares about? Wins and losses, right? And he's smart enough to know that a low ERA contributes to wins and losses, right? If he had to pick between your ERA stinks, but you have a lot of wins, versus your ERA is low, but you lose, which would he pick? The wins. You see what I'm saying? So the ratios aren't the end-all, be-all. We know that they're stepping stones to, and they're accurate measurements of what we really care about, which is net income, healthy cash flow, sustainability of the business.
Just a contributing factor.
Yeah, it's a contributing factor, but like a lot of things too. There's other measurements of Zach's success as a baseball player besides just ERA, right?
Yeah.
Okay? It's one of many. So that was a pretty good analogy I came up with on the spot. Sometimes I really impressed myself. Did you like that, Lauren? Gosh. I know. Well, somebody has to. Okay, what's our last one? Was it exercise 810? Exercise 810? Yeah. This is another Bankrec one, isn't there? Yeah. And I'm hoping there was no errors on this one.
Nope.
All right. Let's take a look at that real quick then. Let me zoom out a little bit. That's a little too much zoom, isn't it? Okay? We're not going to read through that or talk through that. But take a look at that real quick.
I have a quick question on that. As we go through the book, we're given things not in exact order of how it's supposed to be on the bank reconciliation. So, is it okay if I make sure that I know that it's an add or a less and or add, but just write it as it comes along, or does it have to be...
yeah, I don't really care.
Okay.
What Brian is asking is there any magic between the add, deduct? What you're doing is you're probably listing an item, putting it where it's supposed to go, going to the next item, putting it where it's supposed to go. What I would say is this: you're fine, you're okay. As long as you're clear. What do I mean by being clear? Well, what I'm saying is this. You don't want a bank rec just to look like, just numbers, okay? That is not a clear bank rec. That's just a bunch of numbers on a piece of paper. You see what I'm saying? And you want to have this be something that's written down and filed away. You don't want to tell people, yeah, I did it on the calculator real quick and I made sure it all worked out. But I tell you what, I go to clients all the time and I say, show me your bank reconciliations. And so many of them, I can't tell you, they're just like little kids, God bless them. They say, well, oh yeah, we did them. We do bank recs. We do bank recs. And they bring them out, or they bring out what they say is a rec, and it's not a rec. You know what it was? It was the original bank statement that the bank sent them, and they wrote reconciled on the front and initialed it. It's not a bank reconciliation. And I know that they didn't do it because when I did the actual reconciliation, it didn't reconcile. Okay? One time I actually went back and did about 10, 12 months worth of reconciliations for one of my clients. And I found a $1,500 error that would have been in the, that hurt the client, that it wasn't, hurt my client that it wasn't caught. So, I was hoping we could go back to the bank and get this thing straightened out because it was like 8 or 9 months old. Now, we did go back to the bank and we did get it straightened out. And as I so promptly told the client, well, that just offset my fees by that amount, didn't it? You have to do your bank recs. Don't just end. So they weren't doing their bank reconciliations. They said they did, but they didn't. Not unlike if I ask my kids, did you clean your room? Yeah, I cleaned my room. And I go upstairs and not clean. Okay? All right. So, questions on that? Okay, but going back to this. So don't just put a bunch of numbers. Title that baby up. What's the name of the company? What is it? What's the date? And then label everything. And Brian, as long as you're labeling what those numbers are, it doesn't really matter what order you put them in. Okay? All right? Okay. I think that's it with chapter 8. Okay? I think that's it with chapter 8. Can you hand that back to Keeper? Keeper, take a look at that. I need it back before you leave, okay? All right. Let's go ahead and start in chapter 9. All right? And does everybody here, face-to-face, have a chapter 9 PowerPoint like this? Okay? For you folks at home, I've emailed this to you. Okay? So you should have printed that out. I think it's a lot easier to follow along with that. We are going to talk about receivables. We are going to talk about receivables in this chapter. Okay? Now, what are receivables? Receivables are amounts due from customers. Okay? For instance, if I sell an item or provide a service and you don't pay me now, you'll pay me later. So from my standpoint, I have a receivable. In the future, I am going to receive something from you. Does that make sense? Okay? Now, what this that talks about is maintaining a separate account receivable for each customer. Okay? Let me talk about what it's showing here, what it's explaining here. Let me go to here. Okay? Now, let's say that my total accounts receivable, if you go to the balance sheet, okay, my total accounts receivable for my business is $14,000. Okay? You with me? Okay, well, that's great, but somewhere in there, I need to know not just that in total my customers owe me $14,000, but I need to know exactly who owes me what. Is that correct? So maybe I have that detail here, and maybe what I have here is that, and I'll make it somewhat simple, ABC company owes me $8,000. XYZ Inc. owes me $3,000. And let's say Sprint owes me $1,000. Okay? What's the total of that? Hopefully it's 14. No, that's 12,000, isn't it? Okay, sorry, I blew it. We'll add one more at the top. What's that equal? 12?
12, so I need 2,000.
Let's say Hallmark owes me $2,000. And what does that total up to? Okay. You with me? So we don't have on our balance sheet, we don't have a hundreds of lines or whatever for each amount that each customer owes us. We just report the total. Does that make sense? Okay. Now, really, the way you can look at this too is that this is a T account for our total AR. And you can almost look at it this way, that we have like a little T account. This is Hallmark. This is ABC. This is XYZ. This is Sprint. And those amount going off of this deal. Okay? An important designation here. We call this account the control account. Okay? The control account. What we call this down here is the subsidiary detail, or the subsidiary ledger, or sometimes it's called the customer subsidiary detail or the customer subsidiary ledger. Okay? Now leave that up on the screen, but what we have to do is we have to make sure that the total of our account subsidiary detail always equals the control account number. Okay? 8 plus 2 is 10, plus 3 plus 1, that's 14. Yes, that equals 14, doesn't it? Now, let's say that a customer, let's say that XYZ pays us $500 on their account. Okay? XYZ pays us $500 cash on the amount that they owe us. Okay? Well, let's take a look real quick at what that journal entry would be. I think we know. Okay? All right? That's the journal entry, right? But what you'll find that we start to do in this chapter, and we may have even started it a little bit before, is we're going to put in parentheses which customer we're talking about. Okay? XYZ in that case. Why is that? Because when we post this journal entry to the T accounts or to the ledger, well, we need to go to the cash account and debit it for $500. But we actually need to go to both the control account and to the subsidiary ledger to post that $500 credit. So that $500 credit, we need to post it here. So that total is now $13,500, and we need to go to here. And that total is now $2,500. Well, yeah, they might assign each customer an account number, or they might do both. I mean, usually it's both, because if somebody picks up a detail of who owes what, they don't want to cross-reference to a different list on now who's this account. They want to see the name of the, they want to see the name of the vendor because it's just easier. But yeah, usually they have an account or customer number as well. But do you see how if you did not post that $500 credit to both places, the control would not equal the sum of the subsidiary? Do you see that? So every time you debit or credit AR, you've got to take it to the control account, and you also have to take it to the subsidiary detail and ledger. And accounts payable we'll find is going to be the same way. Okay? There's a control AP, and then there's a detail subsidiary AP. Okay? So that's the first thing that this is talking about. Okay? Maintaining a separate accounts receivable for each customer. Now, the other thing that we're going to spend a lot of time talking about in this chapter is accounting for bad debts. Now, we're not going to get into that today. Okay? What I want to talk about is credit card sales real quick. Now, credit card sales are not your typical receivables. Okay? That's very important that you designate this in your brain. Your usual accounts receivable is you provide a product or service and they're going to pay you later. Okay? However, the subject of credit cards is nested into this chapter. So let's talk about credit card sales. What are the advantages of using a credit card? Before you answer that, does anybody here work retail? I've asked this before. Okay. Lauren, where do you work?
Oh, I don't anymore, but
Where did you work?
PacSun.
Okay. Never heard of it. What is it?
Just they sell like clothes from make you look like you're from California.
Okay, cool. Good. Any other ones? What do you work, Zach?
Toys R Us.
Toys R Us. Okay. Does Toys R Us let you use credit cards?
Yes.
Certainly they do. Now, does Nebraska Furniture Mart let you use credit cards? Certainly they do. Now, you know that they charge a fee for that, right? So if I go buy a $1,000 couch, and let's forget sales tax for a second. If I go buy a $1,000 couch from Nebraska Furniture Mart, there's no sales tax, and I just give them 10 $100 bills, then they get $1,000 from me, correct? But if I choose to buy that $1,000 couch, again negating sales tax, and if I use a credit card, there's actually a fee on that, isn't there? Like a 2% fee. Use my Visa. So Nebraska Furniture Mart would only get $980 if there were a 2% fee, and the Visa company would get 2%, $20. You guys realize that? So the question is why, in one case, so what you're saying here, Krug, is if I pay with a credit card, Nebraska Furniture Mart actually gets less money from me. Because that's true, isn't it? So why would they do that? Going back to this slide, why would they do that? What are the advantages? Why can't they just be one of these people that say, in God we trust, all others you got to pay cash?
Because they can get more money off people.
Yeah. Let me say that a little bit more specifically. What do you think would happen in Nebraska Furniture Mart if there was a big newspaper article that said, from now on we are just taking cash? Who would go there, Jake? Nobody would go there. They would go out of business so quick. They would go out of business so quick. Okay? How many of their customers do you think go buy furniture, plasma TVs, computers on a credit card? And they think, I don't know how I'm going to pay for this plasma TV, but I do know this. I want to watch the football game this weekend on this baby. Right? Lots of them. So one of the advantages of credit card sales is it increases your revenue. Okay? The other advantages are listed here. The cash collection is quicker as compared to like maybe a regular receivable. Now, because you could say, well, you don't want to use credit cards, just tell them they can pay you that $1,000 over time. Well, a credit card allows that cash collection to be instantaneous, doesn't it? Or perhaps, depending on the card. Sales increase, as you said, Lauren. We pass on the credit risk to who? Because think about it. If I'm Nebraska Furniture Mart and Brett buys a $1,000 TV on his credit card, if Brett decides to stick it to anybody, who is he sticking it to? Visa. I've got my money from Visa. Now, Visa's going to get money from you, right? And they're going to actually get $1,000 from you, right, if you pay. And then if you don't pay, like some sad Americans, then they'll charge you exorbitant interest rates, correct? That's how they make money. But me as Nebraska Furniture Mart, as soon as you pay with that credit card, I don't have to worry about you. I don't have to worry if you lose your job. I don't have to worry if you become a deadbeat. I don't have to worry if you skip town. I don't have to worry. I am good with Brett because I have money for the TV you purchased. If you stick it to anybody, it's going to be Visa. Correct? So these are the advantages of using a credit card. Now, accounting for a credit card is pretty easy. There are two types of credit cards. In one instance, we get the cash instantaneously. In the other instance, we have to actually send the receipts off to the credit card company and we get paid the cash a little later. And like I said, there's usually a fee. Now, really the best way to learn this is to look at examples. So let's do that. On July 16th of 2007, Barton Company has a bank credit card sale of $500 to a customer. The bank charges a processing fee of 2%. The cash is received immediately. Okay, here would be the journal entry. We record the sales, or we record the sale of $500 with a credit to sales for $500. Now we get our money instantaneously, but we do not get the entire $500, do we? We get only 98%, which is 100% minus that 2% fee, times 500. So what is 98% of 500? It's 490. That's how much cash we get immediately. And then that 2% times 500, that $10, is debited to credit card expense. Okay? All right, any questions on that? That's not too hard. You can read about this in your book. Now, the other method is this. Everything's the same except we don't get the cash instantaneously. We have to remit the credit card sale to the credit card company and wait for the payment, and a little later we receive it. That is all the same except, let me get your pointer here, my pointer. Except the debit is not to cash, it's to accounts receivable credit card company. Okay? Now this is not to the customer. That's an accounts receivable from the credit card company. The customer is good with us when they leave the door. We don't have to worry about them. But instead of debiting cash, we debit AR from the credit card company. A few days later, they pay us, and so we reduce the receivable from the credit card company. Not from the customer, but from the credit card company. You with me? All right. Any questions? Let's see what the next slide is. Okay, let me just go through this slide real quick. There is something called, now we're off of credit cards now. Now we're back on regular receivables. There is something called installment receivables where you simply let people pay you off the money that they owe you over time. This would not be like, let's say I owed Peter $100, and I said, man, I'm short. Can I just give you $20 each week for the next 5 weeks? And he says, sure. Okay. All right. That's all an installment accounts receivable is. All right. Let me give you some homework and we'll call it a day. Okay? All right. Your homework will be right there. Next lecture is real important, so don't skip it, okay? We're going to talk about accounting for bad debt expense, okay? So make sure you engage your brain next lecture, as you should always. But here's your homework for next time, all right? We'll see you guys. Sorry about that error in the book. Have a good night.